Well, hello and welcome back to Finspire's Focus on the Market series, second quarter 2022 edition. I'm Chris Karam, Chief Investment Officer with Finspire. And yes, the title this quarter, The World on Fire. We had everything thrown at us in the first quarter of this year. And so to do a recap, we're going to cover what happened in the world, in the capital markets, in the investment landscape, and how it's changed since the beginning of the year, and give you a look forward about what to expect for the rest of the year. All right. So as many of you have watched, if you've watched previous recordings here and broadcasts, I tend to usually throw a little bit of a nostalgic slide or two in there. And all I could think of earlier this quarter as I was watching this crazy, unjust, unwise war unfold on live television was, wow, we haven't seen this in a really long time. This type of conventional war where you have tanks and bombs and coming in and all live on TV. And all I could think of was growing up and watching Peter Jennings' World News Tonight on ABC. And maybe for some of you, it was Tom Brokaw. Maybe for some of you, it was Dan Rather, or going back even further, Walter Cronkite or Chet Huntley. Who knows? This is before cable television, right? We only had a few sources to watch the news. And news in my family when I was growing up was very important. We had family all over the world, and we always were trying to get a news bit here or there about what was happening from different parts of the world. So I threw in a couple of these and found this interesting picture of Peter Jennings interviewing Mikhail Gorbachev in Moscow. This was probably sometime in the 80s. And can you imagine if this were to happen today, if Vladimir Putin was sat down for an interview with an American news anchor? It would be really something. But as we essentially enter a new Cold War with Russia, we want to take a look. Is history repeating itself, or is it just rhyming? It's pretty remarkable what's happening today. We want to look at the focus, of course, on money and markets, right? This is why you tune in, figure out what happened and where to go with asset allocation and where the investment opportunities reside. We'll take a look, of course, at economic growth, the jobs market, earnings, inflation, and interest rates. Wow, we had so much going on in the first quarter. It's hard to wrap it up in one short recording here, but we'll do our best. So when we look at, first cover the geopolitical impact of what's happening, right? Terrible, tragic. We had coming off of 2 years of a human tragedy of COVID-19 in the healthcare related area. And now we're in this human catastrophe of the Russians invading Ukraine. Where will he be stopped? And it does appear right as we record this today, I know there's a bit of a stalemate in this war, but it is bad, right? There's major human catastrophes. And are any of those catastrophes going to inflame the U.S. or NATO to get more involved? And what does that mean for us? How can we stop Putin globally? How can the free world essentially stop Putin from what he's doing without having some sort of Pearl Harbor event or something that gets the U.S. or NATO countries even more involved than we already are, causing a much greater conflict? So that's very much on the minds, not just on the human, but also human catastrophe, but also, of course, the money and markets. And then what do we do about the Chinese and Taiwan situation? Is one of the silver linings here that China won't want to get involved with what they call reunification of Taiwan, simply for seeing what's happened with the Ukrainians and how valiantly they fought and withheld their ground against the Russians? We'll see, but that would be another geopolitical catastrophe if something like that were to occur. But it is, of course, on the table with all of the bad actors around the world. So what does this mean? Wow, our capital market strategy board is all over the map, especially in the portfolio management area. It's critical. Diversification is more critical than ever. From an economy standpoint, I believe this is one of the trickiest economies we've seen, certainly in my 22, 23 years in the business, and I'll explain why. The employment picture is important. Earnings are going to a very uncertain territory. Interest rates, how high will they climb? Inflation is stubborn and it's been with us and is continuing to persist in the capital markets. So we're going to diagnose about what that means for all of us. Well, let's first take a look at what happened in the first quarter. Commodities, not too surprisingly, were the only safe haven or place to hide, I should say, in the capital markets from an asset allocation performance standpoint, plus 25%. Now, commodities are not monolithic. Every commodity within, whether it's oil, gas, agricultural product, livestock, all beat to their own path of supply and demand. But as you can see, the global scarcity of certain goods and services, coupled with the rise in oil and energy prices, it really lifted commodities in the first quarter. Despite all of the turmoil that we had in the first quarter, the war, the question marks around growth, what does that mean with rising interest rates and inflation? Yes, we were down. Yes, we were down in some cases a sizable amount, like small caps down 7.5%, emerging markets understandably down about 7% in the first quarter. But bonds, right, with rising interest rates, fixed income was down, core fixed income down almost 6% in the first quarter. This was a great challenge for money in markets in the first quarter, and we'll see how this progresses throughout the course of the year. But is it all bad from here? We'll talk more about that in a moment. First, it may not be, because economic growth, although very strong in the fourth quarter of last year, we're going to get our first reading on first quarter GDP come at the end of April. It's questionable, right? The war on Ukraine really kicked in February. So you have approximately half of the quarter that is going to be impacted by the way consumers spend in the second half of the quarter versus the first half. But we were signaling still expansionary territory. Now it's a little bit questionable about what we're going to get from an economic growth perspective. If we continue to see positive economic growth, it's going to be because of consumer spending, whether it's retail sales, e-commerce sales. We're still tracking well above average growth in consumer spending. So we have this excess demand, perhaps from areas such as government spending and relief and COVID-related relief and stimulus, and interest rates being very low for a long period of time. We know those things are coming to an end, in particular the monetary supply, with Federal Reserve poised to raise interest rates. But consumer spending remains strong, and if it continues to remain strong, those inventories have to be rebuilt, and those expansionary areas of the economy have to be met. So that's a big question mark, though, however, especially as sentiment deteriorates. Now, it's not unusual for sentiment to deteriorate when there's bad economic events or bad geopolitical events. Similar to what we have here, when we have high levels of inflation plus a war going on, we typically see consumer sentiment decline, and this has been no exception. We have seen consumer sentiment really fall down sharply from where it was just 6 months ago, and that's important. So consumer sentiment continues to remain an important element of economic confidence, and we'll continue to watch that closely because we really want that sentiment to regain itself. But one thing that can help consumer sentiment and spending is the labor force participation rate, is the employment picture. Now, we had extremely low unemployment recorded in the March 2022 Bureau of Labor and Statistics report, and it was welcome news. Unemployment rate sank to 3.6%, near pre-pandemic lows. However, one of the key indicators we think is even more important at this stage is the labor force participation rate. You can see here that post-COVID, after we had a big exit from the workforce, naturally, when we frankly shut down the economy for a period of time, we saw a plateau after an original spike back up in people participating back in the workforce. We started to see a plateau to this figure up until this year. And over the last 3 months, we've seen very encouraging signs that more people post-COVID are returning to the workforce. If we see that continue, it could really be a magic bullet for handling things like inflationary pressures and controlling wages, which is really a big part of inflation. So yes, the economy is hiring. There are plenty of jobs out there, and we'd love to see more people get into the workforce because it would do the economic growth and inflationary pressures a lot of good. I mentioned that the unemployment rate ticked down to 3.6%. That's a great sign. Wage growth is rising. Not too surprisingly, it's rising in sync with inflation. So when you get inflation, I mentioned this on the previous broadcast, sometimes inflation begets inflation, right? You just chase it. So as inflation rises, other forms of inflationary pressures like wage growth, like energy prices rise with it. And it's a tough cycle to break. But we'll get into that in a moment as to how exactly that could be broken. Earnings. Okay, so we have a drawdown in the equity markets. What does that mean? Yes, it's not good from a monetary value of our balances. However, it does mean that stock prices are lower, and stock and valuations in terms of price to earnings ratios are lower than they were to start the year. Now, that could be a good thing. So if we end up with, in terms of finding deals in the equity markets, this could be actually a positive movement in the reduced price to earnings ratio, because earnings simply appear more attractive. Valuations, I should say, appear more attractive in the U.S. and around the world for that matter. But it's not uniform. So we've talked about this in the past. We've seen areas, for example, the technology sector, which held us together in the first 9 months of 2020 during the pandemic. Those earnings soared, those earnings expectations soared, and so did the price to earnings valuation soared. Now it's energy's turn. Energy, you can see here, has greater earnings per share growth, and their valuations are also lower, as indicated by the black diamond. Now, why is this? It's not quite an apples to apples comparison. No pun intended with Apple Computer, but the reality is that technology is greater than 25% of composition of the S&P 500, and energy is less than 4%. So you'd have to take an active approach to tilt your portfolio to get more exposure to those, say, energy sector, or the industrial sector, or consumer discretionary, as opportunities to be able to rotate your portfolio away from those the larger sectors of the economy like technology and healthcare. Nevertheless, it's not all uniform. There are opportunities. Certainly are investment opportunities that exist and form during these periods of uneven and sector diverging performance. So we talked about rising yields. The rising yields distort the yield curve. So we look at this and call it the yield curve. Well, ordinarily, it's an upward sloping curve. Now it looks like a table. So if you just take a look at where we were as of March 31st, just a mere 11 days ago from today when this recording is being made, you can see short-term rates nudged upwards to 0.25%, but you can see two-year yields went up to a little over 2.25%, and the 10-year yield, which was actually higher, the 3-year or so was actually higher than the 10-year. So this sometimes is known as yield curve inversion, right? And at different spots of the curve, yes, it's inverted where the shorter term rates are higher than the medium term, or the medium term can be higher than the long term. At different points in time, a yield curve can offer you distortions where it becomes inverted. Now, inversions typically mean that there's an economic slowdown or recession on the horizon. It's not always the case, and there's a lot that goes into the composition of a yield curve itself. There are prospects for future growth, prospects for future inflation, that all factor into whether or not yields, where yields are at different spots on the curve. But is that always bad? Always a bad thing? Sometimes, yes. Sometimes it's right, where it's a signal for a slowing economy or a recession is coming. But does that necessarily mean it's all bad for stocks? And that is a good question. So our friends over at Goldman Sachs Global Investment Research took a stab at this and realized, hey, look, the last 2 times we've had yield curve inversions, in particular, the 10-year and the 2-year, whereas the 2-year yield is higher than the 10-year, the stock market has actually fared okay. And now some major events occurred once that inversion occurred, which caused interest rates to come immediately back down. In particular, after 2005, we had the 2008 recession that began in 2007, and interest rates came down, and we actually saw a corresponding rise in the equity markets. In 2019, we had COVID in between there, which actually during COVID, of course, the Federal Reserve dropped interest rates dramatically, and the stock market took off as liquidity expanded in the marketplace. So if you're looking for a crystal ball and say, well, the yield curve now is inverted, so I'm going to get out of the stock market, that has not always been true. In fact, it's rarely been the case where that's a good idea in recent history as we look out over the last 60 or so plus years. So keep that in mind. It could be mean one thing for the economy, but it could mean another for money and your market, for markets and your money. All right. inflation, we've mentioned it in the past, it remains too high. We're seeing oil prices, wages rising. You're still seeing supply chain issues, although they're easing. You still see supply chain issues. Now you're seeing a constraint, if you will, put on certain commodities other than oil and gas when you start looking at things like different types of agricultural products, for example. And this is all putting pressure on inflation. So this PCE inflation, this personal consumptions expenditures, that means what do we as consumers spend money on? The Federal Reserve's target for this is 2%. Okay, and you can see we're well above that. We're at 6.4. And if you strip out food and energy, it's still high at 5.4%. It's poised to go even a little bit higher when the March numbers come in. And you can see these are levels we haven't seen since the 80s, when the pressure on the Federal Reserve, in that case, the chairman, Paul Volcker, the recipe was raise interest rates in response so that we can essentially push our economy and weaken demand to get a handle on inflation before we start cutting interest rates and expanding the money supply to grow a healthier economy the next time around. And that is what's been happening here with inflation. It's being exacerbated, right? This was a problem before the war, but it's being exacerbated by the fact that the Ukraine and Russia in particular, is a large percentage, although not a large percentage of the global economy, is a large percentage of the global oil supply. And so you've seen oil prices surge well into the hundreds. Right now, we're a little bit below $100 a barrel, I think around $95, $96 a barrel. But then on the other side of that, you have Ukraine. Ukraine's one of the largest wheat producers in Europe. Well, how's that wheat going to get out of Ukraine into Europe? There are a lot of question marks there, which is causing strains on certain inflationary pressures, in this case, in the agricultural space. So we have a lot of persistent inflation pressures there. But as we look ahead, diversification remains, as I mentioned from the start, of looking at from a portfolio side, is extremely important. We are spreading our wings farther and wider than we have in a long time, simply because over the last 13, 14 years, yes, if you're invested in U.S. large company stocks and U.S. bonds, you did great. Will that be a remedy? Will that be the winning formula moving forward? It might, but we're diversifying our risks so that in the event that isn't the case, that we have some exposures in areas of markets that maybe we haven't been in a while. Yes, commodities are an interesting way to approach the investment landscape. They're a little bit different. Traditionally, they offer very high levels of volatility, not so much in terms of long-term return. However, they are a great line of defense against inflation risk, or they should help in small doses, can help manage inflation risk right there along with other inflation-protected securities, whether it's equities or inflation-protected bonds, can all help in small doses combined to help manage inflation risk. Bond yields, we'd love to see bond yields settle in at these levels, or in fact even lower levels. That would greatly help the equity market. But along that way, bonds at yields that are north of 2.5, 2.7%, especially in that 10-year bond, gee, it sure seems like they could be entering an oversold market and offer that great diversification inside a long-term portfolio. Geopolitics, we're not out of the woods yet, right? Although it does seem like the Russia-Ukraine war is at a bit of a stalemate, there's still a long way to go there. Keeping your eye on Asia, what that means if China does something in Taiwan. Supply chain, scarcity of commodities only fuel the geopolitical fire that exists out there. So if there's an economic advantage in this type of environment, or if there's a supply chain advantage that can be gained, you have to look out for these bad actors and what they could do in order to enhance their own wallet, if you will, or their own territory, so that their ability to develop, produce, or deliver these different commodities. It is an unfortunate part of the geopolitical puzzle that we live in today. Lastly, when we look ahead, and we'll take a look at this in the next quarterly Focus on the Market series, hey, it's an election year. With everything going on, this is poised to be a very dynamic election year. It's a midterm election year where markets typically get murky for the first 6-8 months of the year. Then all of a sudden you get this surge towards the end of the year. Will that be the case in 2022? We'll take a look at that next time. Mixed leadership in Congress. If the Republicans take the House or the Senate or both, what does that mean for the overall economy? What does that mean for the markets? What has history told us about that when that occurs? So we'll look into all those things, not just what happened in the second quarter, but how we're shape up in the year to date, and again another look ahead as we try to get more clarity in the capital markets. We'll look at all that in the next quarterly broadcast. We're thrilled that you're joining us. We can't wait to see you again and talk to you again soon. Thank you so much for joining us today. I'm Chris Karam, Chief Investment Officer with Finspire, and we'll see you again next time. Thank you.